All right, everybody. Welcome back to another episode of the Mastering Commercial Real Estate podcast. I've got a great guest lined up for us today. We have Teddy Mohlman out of Denver, Colorado with Higher Ground Investment Group. Teddy, thank you so much for being on today.
No, thanks for having me. And you didn't butcher my last name. So that's a great start. And you didn't even ask me how to pronounce it before this. So usually people butcher that one. So good job.
Well, hopefully I'll keep my luck the rest of the interview. So I wanted to do something funny. So I've got my normal just intro with some basic facts, but I wanted to spice it up a little bit. So I got ChatGPT to give you an intro. You want to hear it?
Let's do it.
Okay, so here we go. So it goes, welcome, ladies and gentlemen, to another captivating episode of the Mastering Commercial Real Estate podcast, where we deep dive into the world of real estate investing and uncover the secrets to success. I'm your host, Corey Mortensen, and today we have a true powerhouse in the industry joining us. Please give a warm welcome to Teddy Mohlman. And then it says applause sound effect.
I love it. That's great.
It goes on and on, but I'll let Teddy introduce himself and give us your background to what you've done in the industry with commercial real estate. And I know you do some residential, but Teddy, let everybody know what you're about and your business.
Yeah. So I'm about 31 years old now, born and raised in Miami, Florida. I had done some kind of smaller investments prior to kind of really jumping into the commercial side. But like you stated, I am in residential real estate. So I do about 25, 30 transactions a year there. And the way that I always kind of built my model was with real estate, you can always kind of make more money as long as you keep working, right? There's no cap, there's no roof, which is why I love the industry versus a W-2 or just a traditional job. You can work harder, but sometimes it's not like they're going to pay you anymore. So with that money, I'd always kind of put some aside and invest into smaller single family deals, short-term, long-term. And as that kind of started to snowball, really started to look at other avenues, other asset classes, listen to a bunch of podcasts that I assume a lot of your listeners do, or also yourself, Corey. And at the end of the day, it just kind of trickled down to you have to go bigger and you have to scale, and multifamily and commercial is kind of like that next thing for me. So started to do some JV deals, smaller, JV deals with some couple partners. And then as we just started to get bigger and bigger, the syndication model kind of fell in my lap, and I haven't really looked back ever since. So to date, we kind of manage about 150 units on the GP side, and then combined with LPGP, we have about 400 units that we're currently involved with. And that is in combination of markets like Denver, which is where I'm currently living now, San Antonio, Texas, Iowa, and then we are doing some deals right now in Columbus, Ohio as well.
Gotcha. Of all of the markets that you look at, do you have a favorite? Is there one you lean to more than the other, or are all of those markets pretty equal in your eyes?
Great question. I prefer the Iowa market better just because the cash on cash returns are typically higher. And I'm not one of those investors who like to just do quick flips and exit on a faster note. I prefer cash on cash. I always joke, you retire on passive income, not active income, right? So if you can get better returns on your cash and higher cash flow, then you have more time and more freedom to do whatever really you want to do and continue to get that mailbox money. But to answer your question, I would probably say Iowa. However, given that I'm boots on the ground in Denver, I have a great team in Denver. I have an incredible property manager. Deerwood's PM is who we currently use right now. In Iowa, we have had some trouble really locking in a great PM. They're doing fine, but my business partner and myself, like, we're very, very, we're on it, and I think they just weren't expecting us to be really just along with the ride. They just kind of thought that they're going to do it their own way and just kind of go for it. But we're really hands on our management, so we're really trying to navigate those issues. But again, they're doing what we need them to do, but we just like it to be a lot more than that. So I would say Iowa market. We're just trying to really plug in those final pieces. And as you know, the PMs are the backbone of your business at the end of the day, because they're the ones that are really executing the business plan. We're just the ones that are managing the managers at the end of the day.
Right, exactly. So in your trials and tribulations with trying to find the right PM, what are some of the things that you haven't had success with that other people can watch out for and stay away from? And what are some of the things that you've had some success with and starting to go in the right direction?
Yeah, I mean, you always try to lean on referrals, right? I mean, try to ask other operators in the industry, who they're using, but make sure, and maybe a lesson learned for me is, make sure that who you're asking, they're the ones that are like their business model and their ethics on a day to day align with yours, right? Some people might just say, "Hey, he's a great PM, he's doing what we want him to do," but maybe they're not very as hands on. But like I said, for us, we're very, very hands on, right? So we want to make sure that everything is done, and we lay our entire itinerary out for the week for them, and they do half of it, right? And it's just like, well, we don't just do all this for you guys to do half of it. We're looking, we're asking you to do majority of it, if not all. So I guess really just kind of lead on those referrals. I always, if it's a market out of state, you got to fly in, you got to shake their hand, you got to meet them face to face. Lean on them on their numbers in terms of, when you're underwriting a deal. But really just kind of let them come with the numbers first. And then, given that, we're both in real estate, it sounds like you're also an appraiser, you can really kind of hone in those numbers more is, all right, well, are they on par? Are they aggressive? Are they telling you they want that they're going to get 1,400 a door when it really should be 1,250 or 1,300 a door, but they just want to tell you that so they can get the business and tell you they're going to get more money, right? So I think just really auditing their work. And again, like I said, if it's out of state, making sure that who you are chatting with is not just going to be the PM on site, but also who's going to be your point of contact. Because a lot of the times you're really chatting with the head honcho of the PM company. And then once you sign and close the acquisition, then you're on to Joe Schmo that you never really met. And now you're working with someone completely different, right? So I always try to recommend to have those conversations and shake the hand with your point of contact, who's going to actually be your boots in the ground and day-to-day person you're going to be involved with.
Right. And I want to go into your background and how you got started in all this and your interest in real estate. But while we're on the topic, when you're interviewing potential property managers and they're giving you their terms, their rates, and everything that goes into working with them, what are some of the things that you see commonly and what do you prefer?
Yeah, we typically see, the flat percentage rate. Again, it depends, right? If it's 60 units and under, flat percentage rate. Depending on the market, Denver's like 6.5, with some lease up fees, and then Iowa's a little bit higher than that, 7.5, 8%. That's under 60 units for us, and anything above that, we typically have, obviously someone in house. We're gonna have someone on site that's gonna be managing it. You got to pay them a salary, and then we'll probably have a floating PM that's just kind of overseeing all the leasing. But that we typically see that flat percentage, and then the lease up fees and renewal fees, and maybe some hourly costs if they need to bring in someone to do the handyman work or contract work.
Do you see oftentimes that they will incorporate construction and renovation costs into their fee and just charge a premium, or is it a more separate line item that you have to go out and bid out for?
I've seen it both ways. I've seen some where they have a PM with a construction team, kind of in house that they sort of separate it some ways. Like they'll maybe add a percentage on the construction cost. Like let's say you have a $500,000 capex budget and you inject it over the next 2 years. They're typically going to add 10 or 15% on top of that. You know what I mean? And on some that I've worked with, they just have contractors that they just reach out to get the job done. So I've seen it done both ways. It's kind of hard to say it this way because again, it's really project specific and market specific. But sometimes it's kind of nice to like have a PM where they're just your PM and have a construction team that's just your construction team. However, in addition to that, it's like kind of also nice to have a one point of contact where you're chatting with your PM that's also managing your construction as well. So it's kind of a double-edged sword in some ways. They both have their pros and cons, but really just depends on the team that you're working with.
Yeah. And so for everybody listening, when you're going out and you're looking at property managers, a lot of times when you're first getting started and you're running numbers, you'll run into that flat percentage fee. And usually that's a graduated percentage that decreases with the size of the deal and the size of the property. And
Mm-hmm.
so that rate will go lower the higher the more units in the property. But if there's a lot of things to consider when you're looking at property managers that a lot of people, and even the property managers, have a tough time describing if you don't ask them. So a lot of things go into the property management. What's included? Is renovation included? Do they have a construction arm? Do they do the leasing themselves, or do you have to have another staff member for that?
Mm-hmm.
So there's a lot of things
Mm-hmm.
to take into account that you need to do some upfront research on and have a bunch of questions lined out when interviewing property managers. Wouldn't you
Yeah.
agree?
Yeah, and I always ask too. Even if you got the referral from someone else, is ask the PM for some referrals as well. Someone. Granted, obviously, they're going to give you someone that's going to be on their good side. You know what I mean? But just asking some specific questions that you just want to know on how they operate and whatnot, and then especially asset management is so important for us as operators. So understanding how do they operate with the financials, right? Are they just boilerplate, AppFolio gets sent out once a month and that's it? Or are you able to kind of sit down, maybe their CFO or whoever kind of runs the numbers on the back end with their PM company and say, hey, let's kind of recalculate this. This should have been in the CapEx line item, not a heavy turn, because then you're not going to sell the property in the first year or two while you're doing CapEx, but you want your financials to be clean from day one, because even if you do have an opportunity to sell in year three, a good operator that's buying it's going to be looking at financials for the last maybe year or two, especially if they're going with a Freddie loan or whatever, where they're going to be looking for a couple years worth of financials. So I think that's super important as well, because especially for us that we do a lot of again we invest in our own markets that we live in, but we do also invest in out-of-state markets. And I'm not the numbers guy in our team. My partner Javi is, but he rips those financials apart. And honestly, it has saved us just making sure that we can keep up with where we need to be way early on versus waiting, 6 months in and realizing, oh crap, we're really far behind on this line item or this income or this additional income that we're expecting to get. Because once you can get ahead of it, then you can set yourself up for success.
Right, right. And so going back to you and your background, and I was doing some research, you were a chef before, right?
Yeah.
You got a
Yeah.
culinary school and everything. Tell us a little bit about that and how you made the switch over to real estate and what got you interested in real estate.
Yeah. I think it was 2013. I started to explore around a little bit. I moved to Hawaii just to kind of get out and surf and work and just live the good life after, kind of in between. I was out of high school in 2010 and kind of getting to college and just kind of wanted to explore a little bit. And I always just kind of really enjoyed kind of having people over, kind of being, the start of the party and just kind of bringing people together over some food and some drinks. So that kind of navigated me. Oh, maybe I should do something with food and beverage, right? So went into culinary, really enjoyed that. Worked in some spots in Hawaii, and then ended up moving out back to Miami, which is my hometown, and starting a catering business there and a private chef business in South Florida as well. So did that for a couple of years. Really loved it. It's just one of those things where Miami wasn't where I wanted to be, although it was home for me. I love adrenaline sports. I love the mountains. I love to explore in Miami. Again, it's fun, but it's party, boats, and fishing. And I'm not a big fisher, and I stopped partying a little bit ago. So for me, it didn't really check my boxes for lifestyle. So I moved to Colorado. I mean, you have the mountains as your backyard, and you're able to kind of explore and have that really nice work-play balance. So before I moved back, I was able to sell my catering business, just to kind of my clientele list, and started fresh in San Francisco, and then from San Francisco moved to Colorado when I got the opportunity to start real estate about 5 years ago.
Very good. So what got you interested in real estate? Was there somebody that you knew, or did you see something or doing research already in business and everything? So I'm sure that those kind of discussions happen organically between people, but tell me how you got wind of real estate and got interested in it enough to move into it full time.
Yeah. So it's always kind of been in the family. My grandfather has a successful shoe business in Central America. That's where my mom's side of the family's from. And with the profits from his business there, he's always kind of invested in real estate. That kind of trickled down to my mom. She obviously has kept that portfolio after he passed away and has continued to grow that, however she sees fit. She's bought properties as well throughout her lifetime, and those are all cash flowing for her now. So I didn't really get the bug, I'd probably say until about 5 or 6 years ago. A good buddy of mine in Colorado Springs, he told me that I should get into real estate. He knows I work hard, I hustle, and I love to just kind of really dive into something and really go all in. And he said, really, if you keep working, you keep getting paid. Like I told you earlier, there's no roof, there's no cap. And at that time, I was an account executive for a food distribution company out in San Francisco. And I kept growing my book of business, 20%, 30% year over year. And there was a point where I just wasn't getting paid anymore just because of how the commission structure was. And I mean, I'm very fortunate how much I was getting paid. I was working hard. However, like I said, there was no growth after that. What was the next, what was that next tier of income? And also, I mean, the taxes in California are laughable. So that's when I exited, and it just kind of lined up at the time where he told me about real estate. So got my residential license, like I said, about 5.5 years ago. And that's where I started to kind of really start buying smaller deals with my commission checks. As you know, you're in real estate. If you do really well, you get these big checks, right? And you can have great months where you're making 50 grand a month, and then you have some months where you're making just 10 grand a month, and it just kind of ebbs and flows. And if you have all this money, especially me, that's a general junkie, you want to go buy a snowmobile, you want to go buy another toy, a dirt bike, this and that. So for me to not do that, I just kept buying real estate. So I would always say, I'm always typically cash poor. Obviously, I have my reserves to make sure that in the worst case scenario, I'm covered on all my assets. But I really put all of my money into mostly tangible assets or investments that money can grow for me. Like I said, versus buying something stupid that will probably depreciate over time. However, if you are creative, you can actually buy a depreciating asset and make it work for us, given we're real estate professionals with the taxes. But that's a whole nother podcast.
Right. Yeah, exactly. So let's talk deals. Let's talk about the latest deal that you've done. How big was it? How many units, volume, everything, just give us the overview right now.
You said the biggest deal or the latest deal?
No,
Sorry.
just the latest deal. Yep.
The latest deal, we just closed one in Aurora, just out at the submarket, just outside of Denver on the east side, close to the airport. That was a smaller 12 unit for us, but it was an assumable debt by Freddie, so 3.4% assumable debt with a couple months IO once we took over. Long story short, the apartment was relatively stabilized. It was renovated for the most part. It was just bad management. The investors were living in New York, if I remember correctly, and they just didn't manage the manager. They had no idea what really Aurora was, and it's a very C-class neighborhood that you do get iffy pockets and iffy tenants if you don't really screen them correctly. And the manager they had on site, he was the traditional 4.5%, 5% manager that he just got paid out when he leased. So he would lease them way below market just because he wanted to get those lease up fees. Didn't screen the tenants because he didn't care if they didn't pay. He'd kick them out and didn't do it again. They just get paid out those lease up fees or renewals. So we ended up just going in there really and just doing some light capex, all the common areas and exterior, just to kind of give that little bit of a facelift. We got rid of the bad apple tenants that were causing some mayhem inside the building, punching holes in the hallways and all that jazz. So we got rid of those guys and really just raising rents, adding rubs, and cutting expenses is so it's an easier value add for us, which we're super excited about. And then again, having that 3.4 assumable debt that is also assumable again in the event that we want to sell it in 5-6 years, someone else can take that note as well. So we're pretty excited about that.
That's awesome. And so tell us about your first deal, what that looked like, the process, raising money. Was that a syndication or was that a deal that you did out of your own pocket? Tell us more about that first deal.
Yeah, my first multifamily deal would have been more like a JV. So just kind of smaller pool of partners versus syndicating, like you said, and going out and raising money from outside investors, some people you don't know and some people you do know. So that was a 10 unit in Des Moines, Iowa, just east of Des Moines. It was a good purchase for us because, again, it was old school landlord. They charged, the landlord was even paying for the Wi-Fi, the trash. I mean, everything in terms of expenses was paid by the landlord, and the rents were way below market. Unfortunately, again, very already renovated. So that would be our first deal that we JV'd, and that one, within the first 6 months, we were already stabilized because everyone was month to month. So we raised rents to market, added rubs, made them pay for their own Wi-Fi, which what tenant doesn't pay for their Wi-Fi these days? And that one is actually probably one of our best cash flowing properties to date, just because it was just so below market. We were able to kind of really add that value.
When you were taking a look at that deal, and that was you had experience with investing in smaller deals and everything. When it came time to start analyzing, running the numbers, was that your responsibility? Did you do that, or did you have a partner that ran the numbers on the underwriting?
Yeah, great question. On that one specifically, I had done it myself. I can run the numbers; it just takes me longer. My business partner that I brought in maybe about a year or so ago, he has a finance background. He used to do something very similar in regards to rentals, but was more in the um, like a construction equipment. He even came down to depreciation schedules and all that. Very similar in construction that he owned, and it was a family business that he was the finance guy. He was the CFO behind the scenes. So when he left his family business, he just kind of really wasn't as excited about it and passionate for it. He did some real estate in college as kind of like a second degree. And we met up about a year ago, and he told me what he was looking to do, and I told him what my weakness was, and I was like, "Hey, just come to the office, and let's see what you do." And he literally just sat in the corner and underwrote like 30 deals just to get practice, and barely bugged me, and did it. I mean, 100 times faster than me. And I was like, "All right, I don't know, I can't pay you anything, but you're hired. I'll give you some equity." And honestly, we've been it's a perfect yin to my yang, and it's awesome to have someone that does something that I don't really love to do, right? I mean, he gets excited, he gets jazzed. He gets like weirdly excited about underwriting deals and running numbers and building spreadsheets and showing me how he built them. Like, I don't care about that. I want to look at that bottom number. Tell me if this is a go or no go. That's all I care about. I don't even know about all the formulas you put into it. So, just to wrap that up, I'll say, like, you need to find out what your weakness is, and fill that piece, right? Don't hire someone maybe that's like-minded in regards to like your strengths. I think that's super important. I always like to say, do what you do best and hire the rest, because that will make sure that you're successful with your business.
Yeah, and you answered one of the common questions that I ask is what is your weakness and what is your strength? And you definitely touched on your weakness, how you fix that, how you hired out, or you got your partner with your buddy on that. What is your strength in your business?
Yeah, I'd say more investor relations, capital raising. That's probably more my strength. Asset management just kind of goes with it, just because I prefer to manage my own assets, especially if I'm bringing in some of my friends and family and or other investors' capital. So I'd say that's the kind of the hat that I wear. Obviously, we have other hats as things under contract or in due diligence and all that, but we kind of navigate. After the first couple of deals, we kind of navigated and saw, all right, well, who's going to attack what, who's going to do the other part of it. And ever since then, we just know when an email comes through our inbox, like, he knows that that's mine, or I know that's his, and we'll just kind of run with it. But for me, it's asset management, probably investor relations.
Gotcha. So when it's coming to investor relations and you're going and raising capital, what are
Mm-hmm.
some of the pieces of advice that you have in putting deals out in front of investors, risk management, objection handling, things like that?
Mm-hmm. Yeah, that's a great question, and it's a good question because it's so important, right? I mean, especially like I help some newer guys, through DMM, which is the Deal Maker Mastermind, right? Through Michael Blank's program, and you look at some of these people that are looking to raise capital in these deals, and they have 6-7% year over year rent appreciation, for the next 7 years. And it's like, well, yeah, I know that's how it was potentially the last couple of years in some markets, or maybe even more. But we need to make sure we're conservative and say, hey, what if it just flattens out? Or we're seeing some markets that are in the red this year. We're seeing some markets that are not moving at all. So I think, when it comes to risk management, you just got to really dive into the numbers, almost like if it's your own deal, especially if you're just a capital raiser. You can't just take the numbers like an OM and run with it. Like, you got to run your own numbers and make sure they're aligned. Look at comps, maybe call some PMs and just ask if they think that's appropriate for the performa numbers. And even if you don't know the market, call some agents. I'm fortunate. I'm an agent, a realtor in both Florida, licensed in Florida and Colorado. I'll call up an agent in a market that I'm not familiar with and say, hey, what do you think of this neighborhood? Would love 2 minutes of your time. If the guy's not going to give you 2 minutes, then hang up the phone and call someone else. You know what I mean? But an agent's going to usually just give you his peace of mind if he knows the market pretty well. So really just again, to answer your question, just hammer the numbers. Because one thing I always say too is it's easier to raise money if the deal is actually good. And yeah, you might get some novice investors that might not know the numbers as well. But if you get some repeat investors that, or maybe some family offices that have a ton of capital to inject in syndications, like, they're smart. They're not just going to write you a check. Like, they're going to either look at the numbers on their own, or if they're up there and somebody's hired, high net worth individual we work with, they'll send it to their CFO, to a finance guy, their financial advisor, or they'll send it to someone they pay literally just to underwrite the deal for them. And if you send them a bad deal, like, you might have just burned that bridge, and you're never going to get money from that guy again. So before you present the deal, like you got to really make sure you do your due diligence to make sure, like you said, to kind of just avoid that risk, not only to bring in investors for a bad deal, but to potentially present a mediocre deal to investor and maybe lose that trust with that investor for any potential future opportunities.
Yeah, that's a good point. And being knowledgeable of your underwriting and having the story that supports what you're going to show your investors is one of the most key things that a syndicator, somebody who's going out and raising money, is going to have in their tool belt. Because just like you said, these people are sophisticated, they're smart, they're accredited investors, they've already done well, and now they're putting their money to work that they've worked so hard to accumulate. They're going to double check, and they're going to know what they're talking about. Even if they don't do real estate, they're going to have somebody take a look at it that does do real estate or have a second opinion on it, because they've double checked things through their whole life. And so having correct assumptions and knowing your market and knowing where the market is going, and like you said, not taking a look at an OM or seeing somebody else's projection of incredibly high rent growth at this point in the market. And, we're taping in the middle of summer 2023. Rents have, in a lot of markets, really stabilized or even gone down a little bit just because of how everything has been recently. And so on our underwriting, we're already, healthily conservative, but, we're not really anticipating anywhere over 2 or 3% rent growth, and that's later on in the deal horizon. So all of that is extremely important. What else are you doing in your underwriting to make sure you're staying conservative and in line with the market, your business plan, and what investors will put money into?
I think a big one, a big question that investors always ask is kind of like, what's the biggest impact in your underwriting, right? And I think it's rent growth from what I can understand. Obviously, expenses can be skewed, and that can really throw it off your day, especially if you don't calculate, property taxes being reassessed, right? That's a big mistake that a lot of operators make, especially if you're buying it, 10 years after the previous owner. Some states have homestead taxes where the taxes don't really increase as much, but a lot of the deals that we're underwriting right now, we typically like to say the first 2 years, even before we did 3 years, but we're starting to change that now, is that we actually won't do any rent growth over the first 2 years. However, we'll add, maybe if it's below market, we'll say, hey, we'll bring those rents up to market. But for the first 2 years, we're just going to do that. We're not going to say, hey, we'll bring it up to market and then tack on 4% in the next 2 to 3 years. Our projections right now are saying, hey, we're just going to say for the first 3 years or first 2 years, we're just going to bring it up to market and then not add any rent growth for the next, like I said, 2 to 3 years. Great. If it goes up, even better, right? But we want to make sure, especially right now, given these kind of uncertain times, that we have a worst case scenario. At least in the markets that we're seeing, we're not really expecting negative growth. Obviously, we don't know that for sure. But I'd say right now, that's been one of our big takeaways, is trying to say, hey, you know what? Let's just not expect it to grow. Let's just go flat for the next couple of years and really focus on just getting those units where they need to be to get those performance numbers, or maybe exceed those performance numbers because we did such a good job on the CapEx renovation, and then really hammer just the business plan with expenses and make sure that we can bring those expenses down. There's many ways to do that. I mean, on a big building, if you just add low flow toilets on a 100-unit building or a 60-unit building, your water bill goes down a lot. I mean, like 20-30% in some places. So just doing that, right, versus really focusing on X, Y, and Z, go back to the basics and just do that. And going back to water, do water walks maybe once a quarter. See how many of those toilets are actually just flowing all day, because the tenant's not going to call you. We just did that one of our properties now. We do some dye in the back tank. If we see the dye come out, that means the toilet's, it's running and where it shouldn't be. We'll replace the toilet if needed. And just really just make sure that we're not just having literally pennies just getting dished out all day across 60 or 100 units. That's going to add up over a 5 or 7 year business plan.
Yeah. And another note on presenting to investors is, you say we're not going to anticipate for any rent growth for the first couple of years, and we're going to be really conservative. We're not going to maybe put any below or rent dips or anything, but I think it's important to state there's some risk in those presentations, because a lot of the presentations I've seen from other GPs and sponsors have just been egregiously sunny. You know what I mean? Everybody, there's no negative in there at all. Everything is going to go perfect. They're going to get crazy rent bumps in there. And I'm looking at them like, this is terrible. There's no way. There's no way they're going to get those rent assumptions. There's these crazy expenses that they're not going to be able to trim down. And that's not even from a highly sophisticated point of view, you know, and there's nothing in there that has a gray sky situation or anything. And I think it's important when you're giving those presentations to say, listen, there's this and this risk. We're going to be conservative here, and here. We may take a hit here because of this and that. And investors love that. They love to know that you are fully aware that this could go one way or the other, no matter what. It's not going to be, you're going to make so much money. This is great. You need to invest with us because this is just a gold mine. Investors hate that. They're going to stay away from it. Has that been your experience with?
Well, I mean, when you say that, you'll typically get those novice investors, which is unfortunate, right? Because they're just trying to get into the game, which is great. You know, I love that they're trying to get into real estate. I mean, it's the best asset class that you can get into grow wealth. I mean, top 2, top 3 for sure, right? I know there's other things out there that are similar, but I mean, to answer your question, we have, I think, 2 slides in our pitch deck typically that will show, what are the risks and how are we mitigating that risk, right? And and with that, we'll also provide numbers. Hey, what if we do 7% vacancy or 10% vacancy when we're really underwriting for 5, which is the market average, right? And hey, why do we get hit 7 or 10? Things happen. The economy happens. God knows what's going to go on tomorrow with everything that's going on in the world. And we can't forecast that. However, we'll show, hey, in the event we get 10% vacancy, this is where your numbers are going to be at. So when it comes to our pitch deck and our numbers, we don't give like a perfect percentage. We kind of give a range. Let's just say it's 15 to 18% IRR or whatever, and then 8 to 10% cash on cash. And then we correlate those numbers with that risk management slide and say, the way that we came up with that range is by saying, hey, what if we only did 3% rent growth every single year or average versus the 4 we were projecting? Then this is why we got this number. So again, it provides to the investors, not only are we thinking about everything's all gravy and sunshine, like you said, we got to look at worst case scenarios and things that we have no control of to make sure that we're setting ourselves up for success. And in the event that happens, how are we mitigating that risk? And in the event that we can't do it to 100%, what do those numbers look like? And we're still cash flowing. We're still in a good position. Maybe we didn't hit the perfect number we want on the higher end, but hey, 15% average annual return or IRR, however you want to look at it, that's not terrible. But maybe we didn't give you the 18% that we wanted, but we still gave you kind of within the range. And that's, again, just really hammering those numbers with the risk mitigation and management. So
exactly. And all that just goes back to being realistic and slightly conservative. For deal sourcing and marketing, what are you guys doing to find deals? Sounds like you've done a lot of direct to owner type of deals, or have you been working with brokers? Tell us about where you're looking at deals from and how you're marketing to them.
Yeah, I'd say a lot of it's through brokers right now. Most of them are through brokers. We don't have too much. We have a couple in the single family investment group stuff that we do, like sub 2 mortgage, like we'll take over their mortgage and stuff like that. And that's more direct to seller. But a lot of our multifamily stuff has been through brokers, just, having drinks with them, taking them out to dinners. My partner plays golf. He goes golfing with some of the guys, just staying top of mind, taking those calls. And, I say that I got to get better at it. We typically do every bi-weekly. We're supposed to be calling our brokers and just checking in, just make sure we're top of mind. Sometimes that slips through the cracks as you know, things get busy, but you just got to stay top of mind. And believe it or not, sometimes you call out of the blue, like, oh, you know what? I totally forgot. I should have sent you one deal. I will say, as you know, 95% of them don't work. Probably 98, in this market, but especially the ones that are a little more stabilized, like us as syndicators, we need the meat on the bone. We need that value add component. If not, the numbers don't make sense. So it's typically a little bit harder in that realm. But, we do just kind of make those calls to stay top of mind. All my brokers are kind of involved in my CRM. So whenever they see us get deals closed or get deals under contract, like they know that, we're not just wasting their time. One thing that I'll add on, I wouldn't say it's marketing per se, but really just to create that bond with that broker and also just kind of have some more uniqueness to it is, once you get a deal, my partner underwrites the deal. Usually, again, it doesn't work. He'll actually provide a pretty detailed feedback. If it's like totally off, he just says, "Hey, this is not a good reason, not a good deal for X, Y, and Z reason." But if it's somewhat close, but probably not going to happen. Let's just say it's 5 million and we need to be at 3.5 or whatever, and he knows the whisper price is 4.5. He'll still provide some information on why, pretty detailed email. And I promise you that broker's probably forwarding that to the seller and probably saying, hey, like this is what we're getting, right? Because it makes the broker look good. And maybe all that information and feedback will eventually get the seller to realize, okay, maybe my asset's not worth 5 million because insurance is up. Obviously cap rates are adjusting. We're seeing, interest rates in a very, very interesting volatile environment. So I think that really creates more of a unique touch to these brokers is providing that feedback with their underwriting.
I could not agree more with that. And that's a practice that I use. I am our underwriter and broker relations guy for my company. And that's what I do. I underwrite the deals. If I'm just completely off, I'll just kind of shoot them a message, say, hey, I'm going to be way too off on this. And I'll maybe put in a couple pieces of feedback. But if it's somewhat reasonable on the syndicator scale of broker to syndicator deals, I'll do that. I'll say, hey, here's what I saw on this. Here's your assumption. Here's what I'm assuming. This is what this number looks like. And sometimes I'll even just forward them my Excel sheet and say, hey, if you want to take a look at what I did, maybe I'm wrong somewhere. Maybe I overassumed something. Let me know. And I think that is such a valuable thing to do when you're talking about broker relations, because half the time they send a deal out to somebody and they won't hear anything. They'll, even if it's a good deal, bad deal, that person 90% of the time ghosts them.
I'd say more than half.
They have no idea why. Yeah.
No, I'd say more than half. I've asked a couple of brokers. They're like, dude, I get maybe like 80%. Never hear back. And like you said, even if it's just way off, like just be transparent. Hey, it's way off just because hey, there's no meat in the bone. This is and that also helps kind of remove some of that extra work. Like there's nothing worse than getting a deal that is not going to work. Like the broker should know you, right? And you want to make sure he does, because you don't want to get a bunch of deals to underwrite and then waste your time on half of them when you just know, like, hey, I don't want A class. Why you say, hey, broker, just want to remind you, like, we're looking for C, maybe B class, value add stuff. This A class stuff's just never going to pencil out for us. Because like you don't want to be getting blown up with all these emails. If you're talking to a lot of brokers in different markets, you're probably getting a lot of emails, right? So to try to kind of eliminate some of that clutter in your email box, which if that stuff starts to build up, you get a little stressed, you got a lot of work to do. Just say, hey, this isn't going to be, this not going to work for us. We don't want A class. Only send us value add stuff with good meat in the bone. And then that again, that'll help you out in the long run.
Exactly. And the other tip I would say is, try and get back to them within 24 to 48 hours, because that shows that you're heavily involved, you're actively looking, you're on the ball with everything. I do a fairly good job of it. Sometimes I get busy and it'll take me a minute to get back to them. But yeah, I mean, the getting back to them, giving them feedback, and also that helps you beat the seller up a little bit. Like you mentioned, they are going to take that feedback and forward it to the seller, because it's in their best interest to sell the property. And if that property is sitting and you're the only one giving them feedback, that's the feedback that they have. And sometimes they'll even reduce the price and start to lower and become more negotiable. Whereas before they wanted, 30% over what you can pay type of situation. And so there's a lot of benefits to just having good relationships and communicating transparently with your brokers and being realistic with them.
Agreed. Yeah.
So when you are dealing with your business, running your business, what are some of the team members that you've brought on to help facilitate all of the hats you have to wear as a syndicator and fill a lot of those roles? How many people are on your staff?
Yeah, I mean, right now it's just my partner, myself, and then I have a transaction coordinator that kind of helps with some stuff. Obviously, if you want to look at lending brokers as someone on your team, but obviously they kind of get paid out per deal. And then insurance brokers and all that. They're not really on my team per se, but I would classify them as someone that's on my corner. So because at the end of the day, especially right now, insurance is like, you got to have a good insurance guy. I mean, you got to have this guy doesn't just go out and gets bids. Like, he hammers them. He looks at the numbers. And especially right now, when you're submitting an application, like, if you don't do it right, your number is going to be totally skewed. I mean, totally skewed. So making sure you have a good insurance guy, you have a lending broker that's going to really kind of go out there and, call a lot of banks, especially right now. Local banks are huge. Unfortunately, you might get recourse debt on that. But I mean, if you're really, really excited about the deal and to get, a point and a half less on interest, but it's a recourse debt, that might be something you want to look at. But to kind of answer your question, just like internally within the team, I got my partner, and then I have a TC that kind of helps with more admin stuff.
Gotcha. And so with your crystal ball, your assumptions on the market, where the market is going and where the opportunity is now. It's a two-part question. I'll start with the latter. What is the opportunity right now for commercial real estate investors that you're seeing, that you're capitalizing on? I think you touched a little bit on what I think the answer might be a little bit, and that's the assumable loan situations right now with where interest rates are at, but I'll let you take it.
Yeah, I mean, assumable debt's great, but it sucks at the same time because it takes so long, right? Especially if you're using a servicer. Typically how Freddie will do it, for example, is they'll have a servicer that'll kind of gather all the information together before they actually submit the file to Freddie for the final approval. I mean, for our deal, that took us probably 5 months just to get everything approved and verified through the servicer. And it was a mess. It was terrible. We were on top of them every other day. They were not good at being efficient. They asked us for forms that we submitted 3 or 4 months ago all over again. And so we really took like 6 to 7 months, I think, to close that deal, just given the assumption. I don't know if that's how they all are. At least from what I hear, they're definitely taking at least 4 months, 5 months just to get like that initial stamp approval. So I think those are great because the numbers, but sometimes you pay a little bit more for the price because the interest rate assumption, right? So it kind of has a double-edged sword there. I am always buying in any market personally, just like Warren Buffett buys stocks in any market as well, right? So over the long run, it's always going to work, especially in my opinion, commercial multifamily real estate. The way I look at it now is, when interest rates are higher, you might get a price break on the asset, and then when rates drop, you can always refinance. Very similar to residential right now. A lot of my residential clients are a little hesitant. I'm like, hey, listen, you can buy this asset at a less price because you need to be in that affordable price point. Like, the sellers are going to sell where it's affordable. Where same thing with commercial real estate, the sellers are going to have to sell to hit the debt service ratio, right? Unless they're paying cash or putting a hefty percentage down. So in my opinion, right now, I think we're getting some opportunities are starting to trickle in. I thought it'd be a little bit sooner, especially with some of those rate caps expiring. A lot of these people, operators that bought 2 years ago, underwrote for maybe 3-4% on refi after their bridge loan has expired. We're nowhere near that right now. So I thought we'd see some more opportunities right now. I know some markets are for sure. We're starting to see some big defaults on some big operators. But I like I said, I'm just buying in all markets, and as long as it works for me now, again, if we can refi in the next 2 to 3 years, I think rates are going to be coming down within that time frame. We typically see, looking at historical data, the faster and higher the interest rates go up, we'll typically see the longer and lower it stays down, right? So if you look at the plot map with the Fed, they're starting to see some, this is maybe more 30-year fixed, but they're starting to see some stuff in the low threes in the next 20, maybe late 2024, 2025, right? I don't know if that's realistic. I think it's going to definitely come down. That's what the Fed does: raise rents, slow the economy down. Once it's super slow, they pump the brakes, they drop the interest rate, stimulate the economy again. They want people to borrow money, spend money, everything. It's just kind of this vicious cycle, and it happens as far back as you look in terms of historical data. So that's why I'm buying now. My interest rate might be high, but we're underwriting that will probably be in the mid fives, 5% upon refi. So if we're lower than that, I mean, how that looks in underwriting. It's a great addition to our returns to our investors and our GP side. So I don't have a crystal ball, but all I know is that people are going to be renting especially right now with affordability. I mean, it's so tough for people to buy houses. A lot of people are living paycheck to paycheck. We're, I mean, the highest debt that, not only in the economy, but also just people, individual consumers, um, are in this crazy, crazy debt, to date. And I just think that the rental market's going to stay strong due to that. So I'm buying apartments for that reason.
Exactly. Yeah. I mean, there's so much runway with multifamily and so much opportunity
Mm-hmm.
both now and in the future. And when you were talking, I thought I had a question, and it was, if you were buying properties 3 years ago, and let's say you just nailed it on your exit assumption. You're like, I have a feeling interest rates are gonna double, maybe triple from where they are right
Mm-hmm.
now, and you're underwriting for that. Do you get a deal done? Or is it so
Back
far
then,
off from people's expectation and the pricing, because that exit is going to really hurt from what other people are assuming, where they were assuming
yeah.
lower interest rates and better cap rates. So do you get deals done if you nail it on the head like that? What do you think?
Yeah, yeah. I mean, it's so tough because like if it's like you think about where we were 2 and 3 years ago, right? I
Because
mean,
you never, because it just came out of nowhere. They're like, inflation's all of a sudden 10 to 15%. It's crazy.
yeah,
We got to get it
yeah.
down. And then we've had the last year, but you couldn't have told that.
No
You
one
wouldn't
could.
be able to tell
Yeah,
that.
no one could have really predicted that. And the ones that probably said they did, they're probably lying, or they just, maybe they were close, but I mean, no one thought. Look at the map of our increase of rates over the last 8 months. I mean, there's no way that someone thought they would be that aggressive, right? To the point that look at these banking crises that we're seeing. I mean, it's just it's fascinating to look at the numbers. But I think like as long as you just have those, you know, exit strategies in place where you can kind of say, all right, well, what if this happens? But again, you go back to like no one would really expect that. So we typically look for fixed debt, even if it's going to cost a couple points on our returns, just because we just think that that's the safest route. Um, and the debt that we have on a couple of properties now is in the event that our let's just call it a bridge debt is expiring, we have an option to actually extend it based off of might be a floating rate after that, but at least it's not just like, hey, we have to refinance or we have to sell. We like to have that third exit strategy is like, hey, let's just float this thing out. We might be eating into our returns for the next 6 to 8 months, but at least we at least can have that third exit strategy, which is just let's just float it out for a little bit versus being stuck in a corner where the bank knows you have to refinance or have to sell. I think that's super important.
Right. And the thing that blows my mind is operators who were buying deals with debt and were offered rate caps for just unbelievably low amounts of money. I mean,
Mm-hmm.
it was almost free insurance on your debt. And
Yeah,
now you look at rate cap pricing and it's just unfathomable. I mean, it's so
yeah.
high, it's prohibitively high. And the
Mm-hmm.
fact that operators weren't purchasing those with something that's so important to your return structure, no matter
Mm-hmm.
what the environment looks like, it's like, oh, well, 25 grand for a rate cap. Why not?
All day, all day. Yeah,
Now, I mean, I mean, I can't even begin to
yeah,
tell you where the rate caps are at from where they were.
yeah.
I mean, it's just like 10x
Well,
on all of it.
what's also crazy that too, Corey, is like, what about the smart operators that did get those rate caps, but now they're expiring, right? Maybe they did it 2020, 2019, 2020 or whatever. And now we're 2023 and, they did the right move and they try to protect their investors' money, but now they're just still in an unfortunate situation where either they didn't get with their rent performance numbers or they didn't expect to refi at, 5.5.
Right. Yeah. Hindsight's 2020.
Yeah,
So,
exactly.
but man, well, that flew by. Teddy, thank you so much for being on today. Two more questions. Where can people find you and reach out to you?
Yeah, I mean, our website's Higher Ground IG as an investment group, so highergroundig.com. And then, I mean, you can reach out to me through social media as well. That's teddymo.realtor. I got all my professional and personal stuff on there. I'm, like I said, crazy adrenaline junkie. So anything from me jumping on a plane, skydiving to buying apartments is on that page. So anyone that's listening that wants to reach out and chat more or ask me any questions, I'm happy to help any way I can.
Perfect. And one last tip to send us out to get everybody fired up to go chase down some deals and continue mastering commercial real estate.
Yeah, I mean, you just got to take action. I actually had spoke to another person yesterday about this, and it's like, there's never the right time. The market's never going to be exactly where you want it to be. And one thing I always like to say is, you're going to have to build the plane while you're already flying. You just got to take action. You just got to do it. I mean, if you can sit on the sidelines your whole life, you're just never going to make it happen. So I'm not saying go out there and take action, screw up, but at least you can take action, figure it out along the way, because realistically, a lot of entrepreneurs or hustlers out there, I mean, they're not waiting for the perfect moment. They're really just kind of getting what they got to get done, take action, and then they'll figure it out along the way. And hey, if it's not the right deal, I mean, if you write the contract correctly, you can terminate and maybe just lose a little bit of money or no money at all. So take action.
Exactly. You hear that, everybody? Take action. Again, the best piece of advice from our amazing guest, Teddy. Thank you so much for being on today. I really appreciate you taking the time.
Yeah. Thanks a lot, Corey. I appreciate it.
All right, guys. Well, this has been the latest episode of the Mastering Commercial Real Estate Podcast, and I'm your host, Corey Mortensen, and we'll see you next time.